Very good evening to all of you. Welcome to Demand Supply Trading Practical Session number 31 for the year 2024. Myself, Sujit Kakkar. Today is Sunday, 11th of August 2024. And before we move ahead with the session, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation, risk disclosure, risk involved in the market, and also about the copyrights. Now, we do have a channel on WhatsApp wherein we keep updating you as and when we are scheduling these sessions, or if we have any new videos coming up, or if we have any let's say offers coming up, that is where we'll be updating you. So if you want to join this channel, you can scan the QR code which is on your screen as of now. And in case you need the direct link, then it is available in the description. You can click on that direct link and join this WhatsApp channel. All right, so talking about today's session is practical application of demand supply methodology. So our demand supply course, which used to be a paid course, is now available absolutely free. And if you want to learn this course, the link to the lessons are available in the description. You can go through the complete playlist and learn the methodology theoretically. Now, once you have learned the methodology theoretically, only once you start going through some practical examples, you get better understanding of how it has to be applied. And that is what we do in these sessions. So every weekend, I do a practical session where I take some example, and to that example, we apply the complete methodology. Now, the beauty here is that at the time we are analyzing, we are not looking into something which is already played out, right? We are always planning for the future. And that is the beauty of demand supply methodology, that things can be pre-planned and nothing can be more transparent than planning in advance. And eventually when the trades, they get triggered, then we review it. So it's not that I share these examples with you and then we forget about it. We also track them, we also review them, and that is what helps you build your confidence in the methodology, which is the key if you want to learn something which is which is helping you probably be on the positive side of the market, right? So now, before we start with the analysis of today's example, we do have a few examples from the past which got triggered during this week. So we'll start with the review of them, and once we have reviewed them, then we'll start with today's example. So the very first one for review is session number 30. So the last session that we did, this is how the chart was when we did the analysis. So session number 30 was on 4th of August. And this was a type 1 trade for us when we did the analysis. This is also a very beautiful example where I showed you that even though we have a zone above, I did not go for the zone above, I went for the zone below. I also gave you the reasoning behind why am I going for the lower zone. And that is what I keep saying, that the more number of sessions you'll attend, you'll have a few nuances to learn from almost every other session, and that is how you start being more selective with your zones, right? And you can see the zone above definitely got violated, but the lower zone, we just touched it. And the very next day, we got a move which was almost about 3:1. Now, if you talk about the reward to risk ratio on this trade setup, you will see that we don't have any fresh area anywhere close by. The nearest opposing zone is still a tested zone, which is showing us about 5:1. Can you see that's your nearest opposing zone, which is showing us 1:1, 2:1, 3:1, 4:1, 5:1. So even if you wanted to go for a tested area, you have a reward to risk ratio, which is as good as 5:1. So again, depending upon your personality style, let's say 2:1, 3:1, if you wanted to book some partial profit booking could have been done. But yes, if you're only looking for that, the very first area which is available to us, and that too is a tested area, which is about 5:1, then what you could have done is at 1:1, at 1:1, you could have made it as a break-even trade. So you can move your stop loss from the distal line now to your entry price. So the worst case scenario will be if the prices they go back, it is going to be a free trade for you. If the prices they continue, then we can start trailing onto it. So we'll keep it as an open trade. We'll track it for the next few sessions and see how this one plays out. But definitely you can see in just about a day, it gave us a 3:1 move, where if you like to book some partial profits could have been done, but otherwise you did have the opportunity to make it as a break-even trade. So that takes care of the first example which got triggered during the week. We have two more examples to look into. So just give me a second. Let me bring that up. Just give me a few seconds. I'll bring up the second example. So the second example is session number 26, right? So just give me a second. Perfect. So this was session number 26. We did the analysis session on the 7th of July. And at the time of analysis, this was a type 2, type 3 trade for us. You can see prices came into the zone after quite a while. Now, the problem here is that once the prices are back into the zone after a while, even though it was a type 2, type 3 trade for us at the time of analysis, things could have changed. Maybe it could have got converted into a type 1 trade. Maybe it would have got disqualified by the time prices were into the zone. So I'm not reanalyzing it. We are just simply going based on what our analysis was, and based on that analysis, what could have been the outcome of this trade setup. Though things could have been different if I reanalyze it, right? It could have got converted into a type 1 trade. It could have also been maybe a trade which would not be valid for us by the time prices are back. But just to save time, I'm just looking into what could have been the outcome based on when we did the analysis for this one. So like I said, this was a type 2, type 3 trade for us. And you can see when the prices came into the zone, our nearest opposing zone was this, which was definitely showing us a reward to risk ratio that is a little over 2:1. So reward to risk ratio was not a problem. The only problem here was that it was a type 2 type 3 trade for us, and as a type 2 type 3 trade we need a bullish candle inside of the zone, which we would have never got, because you can see prices just touched the zone, and in about 3 days it gave us our target one, which was about 2:1. So we will consider it as a no trade, and the reason for that is we are still considering it as type 2 type 3. I'm not reanalyzing it to check whether it got converted into a type 1 trade or not, but you can see the beauty of demand and supply. Can you see prices, they just touched the zone, that is where we moved up, and that's your example number 26. Again, I'm not showing you after it has happened. If you will go back and you will watch your session number 26, at that point of time the chart would be something like this, and now you can see the beauty, how beautifully this one worked out, and whatever the target it was showing us, it was achieved in about 3 days, which was about 2:1. But again, we'll mark it as no trade. Reason being, we analyzed it as a type 2 type 3 entry, for which we would have not got the opportunity. And the last one which got triggered, give me a second, let's also bring up the last one. This is from your session number 11, right? So this is way back. Just a second. Right. So this is session number 11. We did the session on 16th of March, and this was a type 1 trade for us. Now the problem here is, you can see we have been pretty close to the zone about twice, but we never got the fill. This is the day when we got the fill on this. But the problem now is that when the prices came into the zone, if you look at your opposing zone is right here. Which is showing you a reward to risk ratio that is less than 1:1. Now, obviously, when the prices were entering into the zone, this zone would have not formed. And the reason for that is only after the closing of the candle, we would be having this zone. But because of that gap down, right, if you're being a little, you were paying attention to it, then we have a rally base and a gap down, which still makes it as a rally base drop structure for us because of the gap down. But the like I said, the problem here is again your reward to risk ratio, and because of reward to risk ratio, we would have skipped it. Now, one thing which we can definitely check is if we are at the best location, because at best locations, if you don't have good reward to risk ratio on the lower time frame, you can definitely move on to the intermediate time frame. Here you can see we were planning it at the best location, but it's the same challenge that even on the intermediate time frame, your opposing zone is right here, which is a rally based drop, which again is showing you just about 1:1. So irrespective whether you were looking at the lower time frame or the intermediate time frame, in both the cases your reward to risk ratio is not very conducive for us to enter into the trade. So we'll mark it as no trade because of bad reward to risk ratio. Otherwise, we've just hit the zone, just hanging around there. Let's see eventually what happens with this one. So those were the three examples which we analyzed sometime back in the history, and during the this week these three, they got triggered. And now that we are done with the review of them, we can start with our example for today. So again, give me a second, let me bring up the example for today. Perfect. Now today's example, I'll say, is not something which is very inclined with our trade plan. I'll say it is a little, I won't say being a little aggressive, it's more like I'm probably ignoring maybe one of the factor, right? That is what I'm doing here. It's just that I just picked this trade because I really like the setup overall. But yes, I'll still talk about what is the only negative side about this one. I won't say negative side, but yes, something which I'll say probably overlooking, right? It's just something I'm overlooking. So we'll talk about it as we progress through the analysis of this one. Alright, so now talking about trading. Whenever I talk about trading, I always say trading has to be a very mechanical and rule-based process. And why it should be mechanical and rule-based, I have explained this in a video called as How to Start Trading. The link is available in the description. Now, during the session, if I talk about some videos, if I talk about some documents, all the links are available in the description. Just go into the description. You'll be able to find all of those links, whether it is to download the documents or whether it is for some videos. Now, yes, like I said, that video helps you understand why you need to be mechanical and rule based, and it also gives you the process which you should start with when you start trading, so that you can understand what is working for you, what is not working for you, by not risking a lot of money in the market, right? So you'll understand that process, and there is no bypassing that process. Everyone will have to go through that process, maybe twice, maybe thrice. But once you have gone through that process a few times, that is where you start building up more confidence in your analysis. You start being a more rule based trader versus being an emotion based trader. So do follow that process. Yes, it is a task, but that task cannot be skipped, right? Everyone will have to do that task. Now, yes, coming back to, since we need to be mechanical and rule based, we have to create something which is called as a trade plan. Now, when you start learning trading or you start learning a new methodology, it is not very easy to create a trade plan from day one, because you're still lacking that experience with that particular strategy. So only when you have a lot of experience with the strategy, it is easier for you to convert it into a step-by-step rule-based process. And to overcome this challenge, what I've done is I have created a trade plan for you, which you can start with. And eventually, as you start having more and more experience, you can definitely make modifications to it to make it better suit with your personality style. Now, this trade plan contains two documents. The first one is your trade plan steps, which we can call as the flow chart or the walkthrough. This guides us what we need to do as a demand and supply trader step by step. Now, all these steps, they have their own elaborate rules, and those rules are available in the rule book. Now, this rule book is a conservative approach, like I was just talking about, with time, with experience. Yes, you can definitely make modifications to it to make it better suit with your personality style, but at least you do have a starting point which can help you plan trades very mechanically, very rule based. And yes, eventually, based on your experience, whatever modifications you want to make into, you want to bring into it, those modifications can be done. So what is my step number one whenever we start planning our trades? Step one is we need to define our trade purpose. Now, what do we mean by trade purpose? Trade purpose basically implies the expected duration of the trade. And the duration of the trade is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss, any kind of exit. So now the question comes that why are we starting with the trade purpose as our step number one? And the reason is, when we do our analysis, the charts that we use, they are time-based charts, and we have a number of time frames available to us. So the very first challenge is that I have so many time frames available to us. So out of these a number of time frames, which time frame should I be using for my analysis? That's the very first challenge. And to overcome this challenge, we do not randomly select any time frame. We go in a very logical way. And that logical approach is that the longer I want to be in a trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration for the trade, the smaller the time frame I should be using for my analysis. Now, what I've done is I have divided these trades into four different purposes. We call them as the hourly income, daily income, weekly income, monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or maybe few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, very important, by definition, I say daily income is a trade which can last for a day or few days. But when you're trading markets which are not 24-hour markets, then you probably would have experienced that almost every other day when the market opens, some symbols they'll gap up, some they'll gap down. And because of this gap up, gap down, what can happen is, if you have a gap in your favor, you might get profit which is bigger than what you were expecting on that trade. But if you have a gap against you, you can also lose more than what you were willing to lose on that trade. So we understand by keeping a position overnight, we have that inherited overnight gap risk which cannot be avoided. So as a risk management rule, my advice to all of you would be, initially hourly dailies should be done strictly as intraday trades. We don't want to take that unnecessary overnight gap risk. So irrespective whether you're in profit, loss, break even, at the end of the day, you should be closing your positions. Now for weekly, monthlies, anyhow, we are not expecting to get the exit the same day. Here we have no choice. We'll have to keep those positions overnight for a longer period of time. Uh, but that does not mean that for weekly, monthlies, we cannot have gap against us. It can still happen, but since we are leaning against some bigger time frames, the probability reduces. Plus, when you're trading the weeklies and the monthlies, your zones are also a little wider, which can also help in absorbing some of the gaps which might come against you, right? But the gaps can still be there. But with time, with experience, if you want to include daily incomes into overnight trades, that can be done. Nothing wrong with that. It's just that initially, as a risk management rule, we would like to avoid that. So my step number one was I need to define my trade purpose. Let's assume I opted I want to plan monthly income trades. Now, once I have selected my purpose of trade, what is going to happen? From the rule book, I'll get to know what time frames I should be using. So if I go to the rule book, page number 28, we start with the topic, which is multiple time frame analysis, because demand supply is not based on single time frame. Demand supply is based on multiple time frame analysis. So what are the multiple time frames we look into? We use a minimum of 4 different time frames, and we call them as the high time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis, intermediate for trend. On the lower time frame, we identify areas of demand and supply for our entries and exits. And the refining time frame can be used for multiple purposes like fine-tuning the zone, different kind of entries like your type 2 type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames? We get the answer from this table. Like in this example, I want to plan monthly income trades. So as a monthly income trader, my time frames are monthly, weekly, daily, and 60. Monthly is the higher time frame, which is used for curve analysis. Weekly is intermediate, used for trend analysis. Lower time frame is daily. That is where we get our SCTS from. SCTS stands for stop loss, entry, target, and size. And in case we need to use the refining time frame, then my refining time frame will be the 60 minutes chart, which can be used for multiple purposes like fine tuning the zone, type 2 type 3 entries, or in case I need to apply some additional rules, that is also where this time frame can help us. Now mind it, this table, which is on page number 31, is specifically for the Indian NSE market, which is the National Stock Exchange, because this market is open for a very short duration, which is 6 hours and 15 minutes during the day. But if you're trading markets which are open for longer duration, like you have your commodities, forex, maybe the international markets, your cryptocurrencies, then you can look into the table which is available on page number 32, right? So again, the one on page number 31 is only for the markets which are open for shorter duration. In this example, we are talking about the Indian NSE market, which is open for about 6 hours and 15 minutes. So as soon as I'm done with my step number 1, now have the clarity to what time frames I'll be using plus what analysis I'll be doing on each and every time frame. So my challenge number 1 is taken care. Now my next challenge is, yes, I do know my time frames, but if I talk about the NSE exchange, I have over 2000 companies listed on the NSE exchange. So humanly, it's not possible for me to sit and analyze 2000 companies every day. So what I need now is I need a process in place which can help me select some symbols out of these 2000 plus companies. Because if I have a smaller list, I can do my analysis almost every other day. But if I have to go through 2000 companies every day, it's not an easy task, right? And how do we get that small list? For this, we use certain computer programs which are called as scanners or screeners. And the way these scanner screeners, they basically work is we input certain conditions into them, that these are the conditions I'm looking for. And then the screener will identify that out of these X number of companies or symbols, which symbols are matching with these conditions. Whatever is matching with those conditions, it gets shortlisted for us. And that is how we get a smaller list. Now, the very first thing you have to remember is, irrespective what scanner or screener you're using, whatever results you get, you can never blindly buy or sell those symbols, right? The scanner screener never tells you what you need to buy or sell. Their job is from a bigger list to give you a smaller list. Once you have that small list, you'll have to analyze each and every one of them individually. Whatever matches with your trade plan is an opportunity for you. Whatever doesn't match with your trade plan, you simply skip it. So a few examples of these scanner screeners. Example 1, if you go to my website under the free tab, you will see I have created some scanners which are on charting, and those scanners are based on some moving averages. Second example, on my YouTube channel, if you search for scanner, you'll be able to find few videos, different scanners, different logics. You like any of those, you can use that. Third example, on my YouTube channel, search for sector analysis. You'll be able to find a video on sector analysis, which can again help you in shortlisting symbols. Fourth example, on my YouTube channel, search for top-down analysis. You'll again be able to find a video on top-down analysis, which can help you in shortlisting symbols. So these are just 3-4 different examples using which you can shortlist your symbols, but you're not restricted only to these 3-4 different scanners. Let's look at few examples before we move ahead. So like I was talking about, once you come to our website, under the free tab, you have stock screener. Because I want to plan MIT trades, I can run the long scan and the short scan. So here you can see the long scan is shortlisting about 7 symbols for me, and the short scan is not shortlisting anything for me. So the first thing is, from 2000 companies, now I'm down to only 7. I can analyze these 7. If anything matches out of these 7 with my trade plan, I have an opportunity. If nothing matches, I don't have any opportunity. Now, many times your list can be a very small list, or maybe nothing is getting generated. So if you want that your list should be a little bigger, because bigger the list, the higher is the probability you might get something which is in sync with your trade plan. Then what you can do is, you can see that in this scanner, I have given 5 different conditions. Disable the third one, run the scan again, and I'll do exactly the same thing here. Disable this, run the scan again. And now you can see that initially it was giving me about 7 symbols, but now it is giving me a list of 144 symbols. And if I go to the short scan where we had only 0, it is giving me only 1. So now out of 2000 companies, I'm down to 145, which I'll say is not a very big list, probably can be easily analyzed in about 45 minutes to an hour. But yes, if you still feel that this list is pretty big and you want to further make it smaller, you can use different filters. Example, I can say I don't want from the cash segment, I only want the ones which get traded in futures. And now you can see I have a list of 36 plus 1. If that one is in the uh, futures list, then you'll have about 37. But yes, you can use different filters, and not just filters. If you go to the screener section, you can see you have over 150,000 scanners available on this particular website. Some are based on fundamental analysis. Then you have your top left candlestick patterns, you have your range breakout, you have bullish scan, you have your bearish scan, you have your intraday bearish, intraday bullish, crossovers. So n number of scanner screeners available to you, and this is an example of one particular website. If you do a Google search, you'll find n number of websites, you'll find n number of scanner screeners. Whatever you feel is the best fit for you, you can use that to get your smaller list. Now in this example, you saw we got a list of about 145. Now, once you start analyzing these, there are few challenges which you will face, right? Challenge number one, what you will realize is that majority of the symbols in this list, they don't have a quality demand zone or a supply zone on the lower time frame. And the reason being, all these scanners are either based on conventional technical analysis or fundamental analysis, which is why just because something is getting shortlisted does not guarantee you'll have a quality area on the lower time frame, right? Because they have nothing to do with demand supply zones. Second challenge, few of them which might have some quality areas, those areas might be far away from the current market price, which means you'll have a longer waiting period before the prices are back into your zone. And during that waiting period, what can also happen is whatever price action develops, it might even disqualify the setup for you by the time it is back into your zone. So these are some of the challenges we face when we have our scanner screeners that are based on conventional technical analysis or fundamental analysis. And to overcome these challenges, I've also created two custom built tools. One is called as the alert service, the other one is called as the screener. Now again, these are not call giving or tip giving services, these are scanner screeners, but the only difference being that these two scanner screeners are purely based on demand supply zones. So what alerts basically does is, now the first thing is the walkthrough videos for both of them, the links are available in the description. You can go through the walkthrough videos to understand them better. But just to give you an example, what they basically do is, so alerts, what it does is that during the live market, as in when you have formation of demand areas and supply areas, it keeps notifying you, for which we have different options. One is we do provide you, a few alerts based on some limited markets like your NSE, MCX, and Forex, and for some limited scripts, because I know most of you might be having a free account on TradingView. So that is why from our end, at least, we try to share some alerts with you. And with alerts, you also get access to the demand supply zone alert indicator, where you can set your custom alerts on any symbol which is available on TradingView, on any symbol which is available, sorry, any time frame which is available on TradingView. So you can have your custom alerts as well. Now, just to show you an example, you can see that on our demo channel on the 9th of August, which is Friday, we had some alerts. Can you see this alert was generated at 11:15 Indian Standard Time on the daily time frame? Then you have on the 5 minutes time frame, 15 minutes time frame, 5 minutes time frame. So you can see as and when these zones are getting formed, you keep getting these notifications. And even if you're placing your custom alerts, then you'll be getting these custom notifications from TradingView, because those alerts are placed on TradingView for you. And what it tells you that on which symbol or what zone has formed, on which time frame, what is the proximal value, what is the distal value. So in a way, as and when these zones are getting formed, you keep getting these updates. But mind it, this is not a call giving or tip giving service. It is not telling you that a demand zone is formed, so buy at this demand, or a supply zone is formed, sell at this supply. It is only telling you that on this symbol, on this time frame, we have a formation of a zone. Now you need to match that zone with your trade plan. If it qualifies, it might be a trading opportunity for you. If it doesn't qualify, you simply skip it. So again, it's not a call giving or a tip giving service. It is just updating you during the live market as and when these zones are getting formed. Now, the other tool we have is the screener. So what screener basically does is that in screener, you can give your list of symbols. And then you can define your proximity setting. Like here, I've defined my proximity setting as 1%. So now what the screener is doing is that out of these 40 symbols, it is telling me, okay, these are the only symbols where the current candle is within 1% to a demand area or a supply area. So now you can see I don't have to go through those 40 symbols. I can simply skip all the rest 36 and I can only analyze these four, because I know this is where I am closer to a demand area or I am closer to a supply area, which is where my trading opportunities might be. So just as an example, if I go to Titan, which is the first one, you'll see we'll be close to a demand area. You can see we have a demand zone. We are pretty close to it. And that is why it got shortlisted for us. And once you have created this list, it can be used on any time frame. Like currently I'm on the daily. If I change it to weekly, now it will give me the results based on the weekly time frame. So that is what your screener is all about. So again, alerts, they notify you based on the zones which are getting formed during the live market, as in when. And for the screener, the zone might have formed today, it might have formed yesterday, a week ago, a month ago, a year ago, a decade ago. Doesn't make any difference, as long as there is a zone on the chart which is matching with your zone quality settings, and the current candle is now closer to it based on your proximity setting, it will get shortlisted for you. So again, these are a few different examples of scanner screeners, two of them purely based on demand supply. The rest of them are based on conventional technical analysis. Whatever you feel is the best fit for you, you can use that for shortlisting symbols. Obviously, the ones which are in sync with demand supply, the probability of finding opportunities which are in sync with your trade plan definitely increases. But the process can also be as simple as, I don't want to use any of these scanner screeners. I want a small list. I will only be analyzing my Nifty 50 stocks, or maybe I have my own favorite list of symbols which I want to analyze. So choice is yours how you get that small list. N number of options are available. I showed you those N number of options. So let's assume you got a list, and in that list, the very first one was ABC. So what are we supposed to do now? On the very first one, we need to go to the lower time frame. So the question here is, what is my lower time frame? We got the answer from our step number one. As a monthly income trader, our time frames were monthly, weekly, daily, and 60. And out of these four different time frames, daily was my lower time frame. And on the daily, I need to identify a zone. By zone, we mean any of these four structures: drop-based rally, rally-based rally, rally-based drop, or a drop-based drop. So if I go to the daily time frame, you can see as of now I have the demand supply zone indicator applied. So I don't even have to identify and plot the zones. The indicator is doing automatically for me. But if you talk about demand supply methodology, always say it's a price action based methodology. Now, what do we mean by price action? Price action means the action done by the price. And what action can price do? Only two things: either move up or move down. But when it is moving in a narrow range, that is what we call or refer as the period of pause, or we can also call it as the basing. Now, when we start learning demand supply methodology, and let's say if you are not subscribed to the demand and supply zone indicator, then what we do is we start with a concept which is called as boring exciting candles, because you will see most of the zones can be identified based on boring exciting technique. Again, I'm saying most of the zones, I'm not saying all of the zones. But as you start having more and more experience, your eyes, they start getting trained. Then from boring exciting, you'll start shifting towards, where do I see that period of pause on the chart? Now, just as an example, if I disable the demand supply zone indicator and I zoom out a little bit, you can see we moved up, we paused for a while, we started moving up, and that is why the indicator is marking it as a rally-based rally structure for us. Now, one thing which I would like to add, that if you go to the indicator section on the trading view and you search for demo demand supply zone indicator, you'll be able to find the demo version of it. You can apply the demo version on the chart. You can use it as long as you wish to try out, how the indicator works, or maybe even to train your eyes how these structures might look like, right? So the demo version is definitely available. Now, if I apply the boring candle indicator, which is an absolutely free indicator, you can use it for free forever. You can see this indicator is telling me that both these candles are boring candles. If I apply the explosive move indicator, which is again an absolutely free indicator, it is telling me this candle is an explosive candle. So now you can see I have identified my basing. To the left, we have an exciting candle, which becomes as your leg in. And to the right, we have a explosive candle, which becomes as your leg out. So irrespective whether you were using price action, we still had a rally-based rally. You're using boring exciting technique, we still have a rally-based rally. Or even if I apply the demand supply zone indicator, we still have a rally-based rally structure, which the indicator is identifying for us. So in all the three cases, yes, we do have a zone available to us. Let's mark that zone. And let's also mark our 1:1s, 2:1s, 3:1s, and 4:1s. So yes, now we have a zone available. Our step number 3 is done. In fact, if you have the indicator is automatically doing the step for you. Now, once we have identified the zone, does not mean we can blindly trade it. And the reason for that is, yes, we might have a demand area, we might have a supply area, but the question always is that, is this demand or is this supply having a quality and a probability which will make it as a qualified trade setup for me, right? So that is what we need to check. And to qualify it, we have a two-step process. In step one, we'll qualify it based on certain conditions, and in step two, we'll qualify it based on the booster scoring. So the very first one is it a case of level on top of level? Now, how do we verify it? It's a very simple concept. If you have an intermediate time frame zone and the same zone divides into multiple zones on the lower time frame, so if your intermediate time frame zone is getting divided into multiple zones on the lower time frame, we call it as a case of level on top of level. So the first thing we understand is that to be a case of level on top of level, my lower time frame zone has to be inside the intermediate, which is called as a coinciding level. So if we have a coinciding level, it might be a case of level on top of level, but if you don't have a coinciding level, it cannot be a case of level on top of level. So let's verify that. Do we have a coinciding level here? You can see on the weekly, we don't have any zone, which means it is not a coinciding level. And since it is not a coinciding level, it cannot be a case of level on top of level. Next, is the zone because of a gap, and that is what I was talking about. You can see that this is a green color candle. This is where we closed and the next day we gapped up. So technically we do have a gap here. Now the problem is that if I want to put this gap in either of the two categories, which is a pro gap or a novice gap, it's not very easy to put it in either of the categories, because it's not like, we were moving down and then we immediately had a gap up, or it's not even like that we have been moving up for quite a while and then we had a gap up, right? So we can't put it under the category of a pro gap or a novice gap. But if we have to still force ourselves in putting it into one of the categories, then I would like to see overall what has been happening. You can see we were trading at very expensive prices, from where we have definitely moved down substantially, right? If in fact, if you look from this high to the low, we have almost moved down by almost, you can see, 66%, right? So which is where I'll say that probably we are now closer to cheaper prices, and maybe somebody was willing to buy a little expensive to get a bigger fill, due to which we got a gap up. So if I have to force myself into putting it into either of the categories, I'll most probably be putting it into a pro gap category. But if I talk about the gap, the way the structure is, I would not like to put it in either of the two. I would simply like to call it as a rally-based rally structure and not categorize it as a pro gap or a novice gap, right? It's simply a rally-based rally structure for us, though we do have a gap here. And that is the only thing which I said, that in this trade setup, I'm overlooking a factor, and the only factor I'm overlooking is gap here, because the gap cannot be qualified as a pro gap or a novice gap. It's just a gap on the chart. Now, next is pivot non-authenticity, not applicable because we only apply to drop-based rallies and rally-based drops. Currently, we have a rally-based rally structure to which pivot non-authentic would not be applicable, and we don't have an unstable equilibrium structure. So after applying all the applicable rules, is the zone qualified? The answer is yes, because none of these conditions disqualified the setup for us, which makes this as a qualified setup. Now, just because it is qualified does not mean we can blindly trade it. The next step is to do our booster scoring. So let's get started with boosters. First one is freshness. The zone is definitely fresh, gets a score of 3. We have an explosive move, which is a score of 2. Time at the basing, we have only 2 candles, gets a score of 2. Reward to risk ratio will be taking as an assumption. Now, talking about location, you will see that we do have a monthly demand zone, but we don't have any supply zones. And we have taken such scenarios a number of times in the past, that when you have demand and you don't have supply, option number 1, skip this symbol, move on to another symbol, because you don't have both demand and supply areas to do your curve analysis. Option number 2, I can use the most recent pivot high, which is this, and I can draw my curve all the way to the demand area, because at least we do have the demand zone. And you can see we are planning our trade low on the curve. So we are at a good location, which is low of the curve, to plan a long trade, gets a score of 1. Now, talking about trend, you can see on the weekly time frame, we are in an uptrend. That is what the indicator is telling us, that the most 2 recent violations were supply areas. And if supplies are getting violated, most probably we are in an uptrend, right? Because in an uptrend, prices will make new high. And to make new highs, it has to violate supply. Move from the zone, we don't have a 4:1 move as of now. You can see we only have a 2:1 move, which will be a score of 0. But if the prices, they move up and then start coming back, this might get upgraded, but currently it is a score of 0. It is not a case of level on top of level, not even coinciding. But for trap, I can give it a score of 1, because if I go to the lower time frame, zoom out a little bit, let's take a horizontal line wherever the proximal is and start pushing it up. You can see this area in the past, has acted like support. Right here it had has acted like resistance, acting like resistance, acting like resistance. Here again acting like support. So we have a really nice clean area of support and resistance. Here also you can see it worked like resistance. So people who believe in support and resistance will be buying here, and below this they'll be having their stop losses, which will be sell orders. And if you have a breakout, then again people believe in breakout will also start selling. So by the time we are into this zone, we know a lot of selling will come into the market because of breakout traders, because of stop losses. And now these are the people who are making novice mistake. They are selling at a cheaper price because prices have already moved down. And in an area where the chart has proven to us that back in history, demand was more than supply, which is the only reason for prices to move up. So that possibility is there that this can act like a trap, for which will give it a score of 1. So if you look at the overall scenario, we have a score of 10 out of 10 for quality and a 3 out of 8 for probability, which makes it as a high quality but a low probability trade setup. And high quality, low probability can be done as a type 2, type 3 trade. In case the prices they move up and then start coming back, it can get upgraded to a type 1 trade, but currently it will be a type 2, type 3 trade for us. So yes, going with the booster scoring, we have type 2, type 3 opportunity. Now no matter how high the quality or the probability, any trade can be a stopped out trade. So we need to be ready for the worst case scenario by doing our proper position size calculation, so that in case the trade does not go in our favor, we do not lose more than what our trade plan, our risk management rule allows us to lose. Now, whenever the prices are back, we'll have to re-verify, because the markets are not static, markets are dynamic, conditions are changing almost every other second. And after verifying if it is qualified, we'll place our order based on the entry type. And once your order has been executed, the last step is your trade management, where step 1 is 1 we make it as a break-even trade, like we saw in the case of our example number 31, which we reviewed today. And after that, if we get the opportunity to trail onto it, we'll start trailing onto it unless and until we get our exit. So this is how we plan trades, very mechanically, very rule based. And again, you can see all the analysis part we are doing well in advance. It's not that after the trade has played out, then we are reviewing it, which I'll say is pretty easy. Anyone can do it. But the real fun is planning in advance and then eventually seeing and watching how these zones they work out for us. Obviously, every zone will not work. We will have winners, we'll have losers, but you can always see the reward to risk ratios are really, really beautiful. Now, even if you talk about a 2:1 reward to risk ratio, which you can see almost every other trade which goes in our favor definitely gives us a move which is about 2:1. So even if you have a 2:1 reward to risk ratio, you can be wrong almost over 50% of the times. You can still be a net profitable trader, right? So always remember that. So that is why I'll say hit rate is not the key. The key is always your reward to risk ratios. And the better is your reward to risk ratios, the more number of times you can be wrong, but you can still be a net profitable trader. All right, so that takes care of our examples and the trades which got triggered during the week. And now let's look into what we have in the chat box. But before I do that, let me add, if you have not yet subscribed to my channel, do subscribe so that you keep getting updated as and when we are planning these sessions. And if you're liking these sessions, definitely like the video. And if you have some friends, family members, or if you're into some trading groups, you can also share my course content. You can share my videos. I know a lot of people are struggling with trading. You never know what might be helpful to them. So yes, spread the word. Let other people also take advantage of these videos. All right, so now let's see what do we have in the chat box. So it starts with I would like to find out what is the best way to compile a watch list of tickers that can provide high probability of providing good demand supply zones. In other words, which criteria should I use? The fact is the best way is the alerts and the screener. Now, depending upon your trading style, let's say if you are somebody who is doing intraday trades as well and you're in front of the screen, that is where alerts can help you. But if you're somebody who's only doing the analysis end of the day, then you're planning your trades and putting your orders, then I'll say screener is more than sufficient. So it all depends what kind of trading you're doing, whether it is during the live market, you still want to analyze and place your orders. And the reason behind that is I'm talking about this specifically if you're purely trading based on demand and supply, because if you're not trading based on demand and supply, then you can use whatever you wish to. But when you're trading based on demand and supply, whatever you have in conventional technical analysis will never help you. And that was the basic idea behind why I created these two tools, because if conventional technical analysis was helping us in shortlisting symbols for demand and supply, then this was in a way not required. Now, the problem is whatever is based on conventional technical analysis, I'm pretty sure you would understand that in conventional technical analysis, everything is lagging. And that is where the issue is that, when you want to take the trade. The conditions you're looking for, conventional technical analysis will never help you filter out those symbols. Now, even if I talk about my personal, uh, the personal trades that I plan, right? Even these trading ideas that I'm sharing with you, these examples that I'm sharing with you, all these are based on the screener, right? Because I only do my analysis end of the day. I don't do it during the live market. So I have, when you talk about, you have these templates on trading view, right? So just give me a second, right? These are called as your uh, templates, so sorry, layouts. So I have about 15 layouts of 8 charts per screen, right? So if you talk about, per layout I have 8 charts, and per layout per chart I have given around 20 symbols. So 20 multiplied by 8 is about 160, multiplied by 15, which gives me a little over 2000 symbols which are on my list. And every day, out of those 2000 symbols, the screener shortlist for me where I'm closer to a demand area or a supply area, because that is where our trading opportunity is, right? If you think about where is my trading opportunity on the lower time frame, whenever I'm closer to a demand zone or a supply zone, that is where my opportunity lies. And that is what we want to filter out. If you use anything which is conventional technical analysis or fundamental analysis, they are not going to help you with that. So again, whether you want to do your analysis during the live market or whether you want to do it at the end of the day, based on that you can make your decision. Alert screener, both can be helpful as far as demand supply methodology is concerned. Can you please remove your logo from the top left? So from the top left, it is there on purpose, and the reason it is there on purpose is because I never share the name of the symbol we are analyzing. And the reason behind that is I don't want to give you ready-made trades. These sessions are not to give you ready-made trades. These sessions are not to give you the fish. It is to teach you how to fish, right? So that is why the name of the symbols are purposely hidden, and I never disclose the name of the symbols. And the other reason is because the methodology is universal. So whatever I'm analyzing, that might be a stock, that might be commodities, that might be forex, that might be Indian market, that might be international market. So in a way, you do not feel that disconnect if you're, let's say, trading some other markets. It could be any symbol from your market, right? But again, like I said, the idea behind these sessions is to learn how to do the analysis, not to give you ready-made trades, and that is why I do not share the name of the symbols. But yes, whenever I'm doing the analysis, whenever I'm reviewing it, you can always go back and see that it's going to be the same chart, right? Because at least you can see the price action is exactly the same. All right, so rather than randomly looking for tickers to trade, is it possible to replicate the scanner you use for MIT, DIT for the US market? See, you can replicate that, but again, like I said, it is not going to help. And the reason it is not going to help is because everything which is conventional is not helpful with the demand supply methodology, right? The only reason I have it there is so that people who do not have access to alerts or screener, right? They have not subscribed to alerts or they have not subscribed to screener. At least they have something using which they can filter out. But eventually you will realize that that does not help a lot. And it's more of analyzing such symbols where probably you're wasting a lot of time because most of them will not have quality areas. So the best way is, and in fact, now let me also give you another reason. Now, even if we had a way with which we could have done, see, the fact is there is no way. The easiest way is these two. But let's assume if there was a way, then the second challenge would be that every day putting that list into the alerts or putting that list into the screener is again a task, because you'll have to go through, each and every uh, uh, symbol and input that symbol into the screener or the alerts, which is again a very big task. So the fact is there is no way to do it. The easiest way is whatever markets you analyze, based on that, just create your list. I just give you my example. I have all 2000 plus companies listed for me in my screener, and whatever is getting shortlisted for me, out of that I choose. And if your market has a very big list, then you can be even more selective with your zones, right? You can say, okay, I just want the best of the best zones, and I need to be very close to the zones. Let's say if I give it as 10%, it will shortlist too many symbols for me. But if I give it as, let's say, 2%, it will only shortlist symbols for me where I'm within 2%, which means probably in a day or two, I might get my trading opportunity as well. So that is the best way to do it. Conventionals will definitely not help. Okay, so if I use the logic you use in your scanner for ticker in various trading purposes, I would like to use the candidates, put them through. the demand supply scanner. So, like I already said, that in itself would be a task. I mean, if there was a way to filter out, right, where the conventionals could help us, then putting it into that screener every day in itself would be a task. Now, the first thing is, like I already said, conventionals will not help. And even if you try to do it, eventually you will realize you're just wasting your time, right? So, the best way is create your list, then just help the scan, let the screener or the alert service shortlist for you, and then based on that you should be making your decisions. Conventionals or fundamentals are never going to help you with that. The only reason, like I said, I created them is so that people who do not have access to the alerts, do not have access to the screener, at least they have something to lean against. But eventually, over a period of time, 1 week down the line, 2 weeks down the line, 3 weeks down the line, a month down the line, they will realize it's not very helpful, and that is when they will have to make some shift, and that is going to be their decision what shift they want to make, right? But conventionals will never help, and even the fundamentals will never help. All right. So rather than bombard you with questions on how to optimize the tools, would it be possible to contact you and ask specific questions? I submitted to. See, the problem here is that almost every other day we get loads of emails. So humanly, I'll say it's not possible for me to respond to every one of them. And my support team, they are not traders, right? They are only there to help you with, let's say, if you're not able to access any of the service, you're not able to subscribe, or something is not working for you. So they can only help you with the technical side of our products, not the technical side of the analysis. So when it comes to analysis or reviewing something, I can only do it. And that is why I thought a live session would be the best way to do it, because can you see in the live session, I can show you examples. And again, putting something in text is much more challenging. Explaining it in a live environment is much more easier. And plus, if somebody emails me, I reply to them, only they get the benefit of it, right? But if we are having a live interaction, even though you ask the question, 100 other people who are later watching the recordings or maybe joining the session as of now, they will also have that advantage, right? So in a way, this is a much more, I'll say, easier way for everyone to take advantage of it versus if it would have been on an email. And again, like I said, the only problem here is I get n number of emails every day. Humanly, it's not possible for me to respond to each and every one of them. Plus, even if I respond to them, uh, having a live interaction makes it much more easier for me, right? In fact, if there was something where I had to show you some examples, I could have also shown you some examples. So that is why I always keep it this way, not based on the email interaction, right? Because even if I try to do it, I know I'm not it won't be possible for me just because of the volumes of emails that we get, right? So I apologize for it. Live session would be the best way to go about it. All right. Let's see. Question I asked were specific to trading methodology and how to leverage the tools you offer to optimize time you spend searching. Absolutely. And that is what I just helped you with. That yes, when it comes to demand supply, nothing can beat alerts and screener. Using conventionals will not help you. Now, let me now give you a very simple example, right? So let's take a very simple example here. Let's go back here and let's say I want to create a scanner. Now, in conventionals, the first thing is I can't use demand and supply, right? So let's say I want to plan, not WIT, let's say I want to plan MIT trades. Now, if I want to plan MIT trades for the HTF, we need demand supply zones. So I can't use demand supply zones on a conventional screener. On the lower time frame, again, we need demand supply zones, which I can't use on a conventional screener. Now, the only thing I'm left with is the intermediate time frame, right? Now, in intermediate time frame, what we are trying to do is, let's say I want to plan a long trade. I would like to identify something which is in an uptrend, probably giving me a correction, which might bring the price into a demand area. And then I want to plan my trade, right? So let's take an example. I want to create a screener which is helping me shortlist something like this. So as a monthly income trader, my intermediate time frame is weekly. So just as an example, I can say that my closing should be greater than exponential moving average, and let's give it as 20 period. And because we are checking the trend on the weekly, let's give it as weekly. So what I've done is I've told the screener that find me the symbols where probably I'll be in an uptrend on the weekly time frame, right? Because we are saying the weekly close should be greater than your 20 period moving average. Now this I can't change, you can see, otherwise I would have given it as the weekly close as well, but let's give it something like this. So now if I just run this one, you can see it is giving me a list of about 977 symbols. So from 2000, we are down to almost 50%, but we still have 977. Now, like I said, Now putting these 977, which will be again different symbols almost every other day when you do your scan, into that screener is not an easy task. Now let's say I want to further filter it out so that my list is smaller. So now how can I find something which is also giving me a correction? So let's assume I opt, let me use RSI for it. So I know that I'm in an uptrend, but I need a correction. So what if I am able to find symbols which are currently trading less than my uh, RSI, which is 30, because that is telling me that yes, we are in an uptrend, but currently we are also at a cheaper price, right? We are oversold, right? Under 30 is oversold. Now if I ask you people, okay, give me your numbers in the chat box, you can see currently it was giving me 977. So what do you think, how many symbols will it shortlist for me once I run the scan now, after adding the RSI? So from 977, just give me a random number. How many symbols do you think it is going to shortlist for me? And so let's see, just as an example. So before I run it, I need the answer from you people. From 977, all right, Gaurav says 50, 300, about one third. Okay, now my guess is zero. It will it will give me zero results, not even a single symbol. So can you see if I run, it is giving me zero. Now if I put it as let's say 35, again my guess would be probably again zero. You can see again it is zero. If I give it as maybe 40, probably again it will be zero. That is what you can see. 45, maybe one or two, but I still expect 45 would again be close to zero. You can see 45 is still zero. Now if I push it up to 50, now it might start giving me some results. Now can you see if I run it on 50, it is giving me about 21 symbols. So if you think about it, if I'm already at 50, I'm not either overbought, I'm not either oversold, I'm still in somewhere in between, right? Now how did this scanner basically help me? It didn't help me in any ways. So that is what you need to understand, that all these conventional technical analysis, they are, first thing is they are lagging, right? If they are lagging, they are not going to help you. Plus the conditions which we are looking for, most of the times those conditions, they do not exist, right? If you are creating a scanner which is technically, I'll say, very accurate to what you're looking for, most of the times you will get a very small list, or it might not generate even a single list. So that is why it is better to only look for what you actually want, right? I actually want the symbols where on the lower time frame, I'm just about to enter a demand area, I'm just about to enter a supply area. Now if I start putting these filters, I would also be missing a lot of opportunities. Right now, just as an example, it has given me around 21 symbols, but it might have skipped maybe 50 more symbols where maybe I was just about to enter a quality demand area, but because it was not matching with my conventional technical analysis, it never got shortlisted for me. And can you see, now this is the reason now I can't explain all this in an email, but in a live environment, it just takes me a minute. I can do it and I can help you understand why these things are not going to help you, for filtering your symbols. So that is why I prefer to have these questions queries in a live environment versus doing it in an email, right? So I hope you understand now the reason behind why it is very challenging with the emails. All right, so let's move ahead. Let's see what is the next question we have. Okay, questions so I've already answered that. Do you always consider fresh zone, tested zones when doing curve analysis, which is okay? So when it comes to curve analysis, because I am mostly planning MIT trades, I don't mind using tested areas. But if you're planning, let's say, HIT trades, then my recommendation will be always use fresh areas, right? So the more aggressive you're getting, or the smaller the time frames you are using, the more conservative you have to be with your approach, right? But the bigger the time frames, the higher the weightage. That is where you can use tested areas, but again, on the lower time frame, I'll still always be using fresh areas. The only exception would be in case of level on top of level. I might be using a tested area, but if it is not a case of level on top of level, lower time frame, always fresh. For curve analysis, for MITs, I don't mind using tested areas because we are leaning against very big time frames where it is perfectly fine even if these zones are tested. Okay, so thank you for providing me with some guidelines I can use to utilize and optimize your tools. Greatly appreciate it. Live sessions are golden nuggets. Absolutely. Thank you for answering my question. Okay, you don't have to thank me, right? That is what these sessions are all about. And yep, if these sessions are helping you, I guess I'm doing my job well. All right, so let's see. I get it. Best way is to show through example. Absolutely. Now, can you see? Because I showed you through an example, probably now you'll have a better understanding why even if you're trying to find something, why it would not be very fruitful to you. And even if you get a list, like I said, you got now 21 symbols there, but there could be another 50 symbols, 100 symbols where you're almost about to enter the zone, but based on these filters, those symbols, they never got shortlisted for me. So if you think about it, the end result we always want is, where is a demand area where I'm almost about to enter a zone, or how can I find a supply area where I'm almost about to enter, or uh, how can I find symbols where we just had a formation of a demand zone, or we just had a formation of a supply zone. So this gets taken care by alerts. And like I said, this is more useful for people who are planning trades during the live markets, because they want to get updated where and when these zones are getting formed. And people who are doing their analysis end of the day, this is where it can help you, because now you want to know where I'm almost about to enter a zone. That is the only symbol I want to analyze, right? What conventional says now is irrespective for me, right? Because I just want to find where am I getting closer to my opportunity, right? And then just verify whether it matches with your trade plan or not. All right. So how to know demand supply zones worked in a free version of trading view? See, again, if you talk about the free version of demand supply indicator, the free version will only work on the daily time frame. So if a zone has been identified, you can always mark that zone on the chart. Even if you go back, if the zone has been violated, you will still see the black color for the explosive candle, the leg out candle, and the blue colors for the basing candle. So the indicator does not repaint. So if the zone has been identified, it will remain on the chart forever. The only difference is that once the zone has been violated, those horizontal lines are removed. But here, like you can see, we had a supply area. Now you will always see that supply. It's just that the lines have been removed, because if we don't remove these lines, then what is going to happen? Your chart will be, full of all these areas which were there in the past, and now they have been violated. So that is why, to clean the charts so that you can, use those charts, the horizontal lines are removed after the zone violations, but where were the zones formed in the past, they are still there, irrespective whether it is the free version or the paid version. All right. Okay, light bulb lit. Thank you. Use the scanner and the alerts, and let the tool assist you. Absolutely, right? That is how it has to be, because in conventionals and fundamentals, nothing is going to help you. I was asking myself, do we have a trading purpose where weekly is lower time frame? Absolutely. So if you want to do, let's say, weekly as the lower time frame, see, again, I have given you 4 different trade purposes, so that does not mean you only have to stick to these. Now let's assume that somebody wants that I want to plan trades where I am in that trade for a quarter or maybe few quarters. Then I can say we can have a quarterly income trade. Now for a quarterly income trade, your higher time frame can be quarterly, your intermediate will be now monthly, your lower time frame will become as weekly, and your refining time frame will be daily. So absolutely, can you see that can be done? Now let's say if somebody says I want to plan trades which are half yearly income trades. Now your higher time frame can be half yearly, which is 6 months chart. Then you can have your quarterly, you can have your monthly, you can have your weekly. So again, these are just few examples. Now depending upon how longer you want your duration for the trades, or how smaller you want the duration of the trades, you can always mix and match these time frames, and this will help you understand how to set your time frames so that you can do your multiple time frame analysis for that particular style of trading. Okay, demand supply zone indicator provided by you, working in trading view free. Absolutely. So if you have a free trading view account, it will work, right? There is no problem with it. But what you need to remember is that if you have a free account, you still have that limitation that you can only apply 2 indicators. So if you already have 2 indicators applied, and then you are saying, okay, I have subscribed for the demand and supply zone indicator, I'm not able to add the third one, that limitation will remain there, right? But yes, on a free account, if you are subscribing to our demand supply zone indicator, out of the 2, one of them can be the demand and supply zone indicator. Okay, thank you. Another fantastic presentation. Looking forward to the next one. All right, perfect, great. So good to know, these sessions are helping you. And again, I understand that at times when we send email, we always have that expectation that we get the reply on the email itself. But I hope it was easier for you to understand the challenges today, because in text it is not very easy for me to respond. Plus, even if I try to, the number of emails I get almost every day, it's too many emails, so humanly it is not possible for me to reply to all of them. So why not to keep it in a way where the interaction is live, I can show you, I can help you understand, which makes things much more easier. All right. So again, thank you everyone for joining in. I'll be seeing you now next weekend. Till then, trade safe. Enjoy your Sunday. Take care. Bye-bye.